All right, traders, let's quickly take a look at where we are trading across major asset classes. I mean, what an incredible week it was last week. Massive meltdown across the markets. I mean, no asset class was spared last week. It was a complete bloodbath in certain assets. I mean, let's start with equities. When you look at things like the Nasdaq, which has now officially moved into bear market territory. I mean, we're down 22.5% from the all-time highs. If you take a look at something like the S&P, same story there. We're currently trading down 18%, so very close to what we would call a technical bear market, which is normally just a 20% correction in equity. So I mean, massive meltdown for the likes of equities. Similar story. I mean, if we take a look at things like volatility, the VIX specifically, what a massive move. Jolting up to 32.5. Now that 35 level is a very important one for us to watch in the week ahead, should we get there, and I will touch on why that is in a second. But let's just take a look at some of these other moves. I mean, let's take a look at yields wasn't spared. Bonds obviously ripped to the upside as a safe haven asset, pushing yields lower across the board. Looking at commodity markets, I mean, downside, immense downside here. I mean, take a look at oil trading back down to 4-year lows, just shy of that $60 per barrel level. Monster move there. Copper, complete meltdown, going from all the way up just a few sessions ago at 5.2 all the way down to $4.34. I mean, it's crazy moves. Massive reduction in silver, big push to the downside in gold. And of course, if we take a look at equity markets or FX markets rather, even though initially the dollar suffered last week, the sheer amount of risk off flows that we had eventually saw that safe haven bids coming back into the US dollar. And we obviously had a very solid rally in the dollar index, all the way down from 101, what was that? 101.25 all the way up to that 103 psychological level. So what exactly happened? Why did we see this meltdown? It's important here to understand that markets, we've already seen stress playing out for risk assets over the course of the last few weeks, right? A lot of this is down to concerns which has already been brewing from a few weeks ago about the US growth trajectory, right? Are we going to see growth supported? Are we going to see a big slowdown in the economy? These have been key things that's been driving the dollar as well as equities for the last few weeks. So it wasn't a Thursday, Friday story. The growth story has been something that's been there underlying as an issue. We've seen that in the likes of the Atlanta Fed GDP nowcast, which even drifted even lower with the recent data. I mean, if we take a look at this update that we had last week, the normal model for the Atlanta Fed GDP nowcast. Now, for those of you who don't know what this is basically just a forward-looking measure of Q1 GDP in the US. Remember, Q1 GDP is a very lagging indicator. We get it a couple of weeks after the quarter has already ended. What this gives us is like a fresh snapshot as US data comes in of where this model thinks GDP will land. Now, it's fairly accurate. There is obviously some variance in the model that we'll need to always address for or account for. But for the most part, it's pretty accurate, right? So we can see that for Q1, we're sitting at a negative 2.8%. Now, that is unadjusted for gold imports and exports. If you adjust it for gold imports and exports, that number is negative 0.8. Now, that's miles away from the 3% growth that we had in Q4, right? So this has set the mood, it's set the backdrop. This growth slowdown fears, it's been there. Now, what has exacerbated this last week, of course, is the massive tariffs that was imposed by the US on their trading partners. Now, look, when it comes to reciprocal tariffs, there's a lot of pros and cons to the reciprocal tariffs that was touted by the Trump administration a couple of weeks ago, right? But what we got last week wasn't close to what they say they were going to do, right? The numbers, the average or weighted number for the tariff comes in around 25% if you take a look at it at a global scale. The problem for the markets with this tariffs isn't the fact that it's reciprocal. It's the fact that the way that they got to the numbers, the math itself, makes the markets uneasy. Because what they did essentially, right, is they took the trade deficit that they had for any particular country, they divided that by the imports, and they divided that number by 2, and that gave them their tariff. So for the countries that where the US actually had a no deficit, or where they had a surplus, those countries just got slapped with a blanket 10%, and everybody else got more, depending on how big their trade deficit is with the US, or how big the US's trade deficit is with them. What makes the markets uncomfortable about stuff like this is that this type of math, it doesn't really make a lot of economic sense, right? The amount of uncertainty that this has given the markets, you can see that displayed in the likes of the move in equities, the likes in other asset classes. The markets are really freaked out by this. It doesn't help when you have the US Treasury Secretary coming out being asked about these big moves, and him saying, oh yeah, this isn't a Make America Great issue. This is actually just a Mag 7 issue, pointing to things like the DeepSeek sell-off that we had a couple of weeks ago. It's got nothing to do with that, right? It's got everything to do with the policies that you're putting in place. And when you try and just brush it off and say, oh yeah, it's not an issue, this isn't a policy issue, that makes the markets uncomfortable, because Besant was always seen as a type of voice of reason for the markets, somebody that should come in and just calm things down. And right now, off the cuff, he seems to be one of the aggravators of this whole story, right? So the markets are uncertain. Now, what makes this sell-off interesting here, right, is that the markets, we just don't know what type of impact this tariffs will have, right? We don't know how much pain can still be priced in, or when adequate pain has been priced in. And the reason for that is we don't know what the end numbers will be. We don't know how markets will, trading partners will respond. We've already seen China stepping up to the plate on Friday, pushing back, adding the 34% tariffs back on the US products as well. We've heard that the EU will also start, obviously, putting up retaliatory tariffs as well. So where we are right now is we don't know what the end numbers will be. That's the first reason why we can't really, or markets can't really manage risk right now, because we don't know what the end data will be. And let's just say we do know what the end numbers will be. We don't know what type of impact this will have on the sentiment for US products. We've already heard stories anecdotally coming out from Canada. I'm sure most of you have seen the pictures where you have in supermarkets, people are only buying local. They're only buying Canadian products. They don't want to buy US products. So we don't know what the repercussions of that sentiment shift will be in the markets. Furthermore, we don't know what the numbers will mean for the data. The problem is, let's just say the tariffs gets imposed, right? And we get retaliatory tariffs. We'll only know a rough estimate of how this is going to impact things in about 6, 7, 8 weeks from now, when we start getting April data coming in. So that makes things really tricky. We don't know. The markets just don't know, right? So when you have this amount of uncertainty, it's very difficult to know how much fear still needs to be priced in and when we've reached that adequate level of fear. The other thing to keep in mind here is that regardless of everything that I just said, we always need to keep in mind when it comes to risk assets, especially things like equities and the stock market isn't the economy, right? So even if things do get really bad, if we have enough policy support on the fiscal side coming out from the US administration, like tax cuts, other supportive measures, or if we get support from the monetary policy side with the Fed potentially cutting rates more aggressively, those are things that can still provide upside for equities, despite the economy going into a potential recession, right? Despite slowdown fears, despite all of the negativity. So there's just so much stuff going on right now. We need to be very, very careful because the markets just don't know what's going to happen. Now, what happened on Friday is we saw something close to, I think it was the biggest sell-off we've had in equities. Well, not in terms of sell-off, but hedge funds dumping positions. I think the biggest outflows since 2010. So that tells you something. Just monster moves across the board. I think it was also the biggest amount of margin calls for hedge funds since something like COVID, right? So it just shows you the sheer amount of uncertainty that's going on to the market right now. So where does this leave us going into the week ahead? Well, again, it's tough to say how much fear has already been priced in and how much can still be priced in by the markets. The one thing that we do know is that we need to be incredibly careful. For the long-term investor, the long-term, long-only allocator, they will look at these numbers in equities and saying, hey, I just got a 20% discount to buy the NASDAQ, right? So, or an 18% discount to buy the S&P. So from a passive investing or a longer term point of view, they like these numbers because they will start reallocating back into equity longs when they see types of moves like this. For the short-term trader though, the day trader, the swing trader, you need to be very careful in a week like this because when volatility ramps up as much as it has across major asset classes, volatility works both ways, right? It doesn't just work to the downside when vol rips up. When volatility gets as wide as it is and you see those weekly variance levels widen out, it works up and down, right? You can have massive sell-offs like you had on Friday, and you can see a face ripper of a rally the next day, right? So we need to be incredibly careful as short-term traders here. The amount of uncertainty is not for everybody, right? When volatility ramps up like this, there's very, very few traders who actually make money in environments like this. If you are up from last week, fantastic. I guarantee you the vast majority of participants last week lost money. There's going to be a lot of players that got blown up on Friday with these moves. So you want to be incredibly careful right now. These are not the environment to try and be a euro. There will be great volatility coming out of this, both up and down, but you really need to pick your levels carefully. You need to pick your moment carefully because things can get really, really gnarly. Now, what about the week ahead? Do we have anything that we can, use as possible catalysts to trade? Firstly, on the data side, we do have US CPI coming out, right? Will CPI even matter after last week? I just don't know. Personally, I don't think CPI is going to be a big driver. If the data does come in hotter than expected, so higher than expected inflation, I think that will probably matter more than a low number, because the Fed already told us on Friday that, they're in no hurry. Fed Chair Powell told us they're in no hurry to cut rates. Despite that, the markets have already fully priced in 4 rate cuts for the Fed this year, based on the moves that we had on Friday. But Fed Chair Powell, he also added to some of the pain Friday, because he said, listen, we're in no hurry to cut rates right now. Inflation is still high. The labor market is still doing okay. We're in no hurry right now to make a move and potentially cut rates here. So if inflation were to come in higher than expected, that probably matters more because it keeps them patient, which is bad for the markets, and it increases those stagflation fears that's been brewing for a while now. If the data comes in lower than expected, maybe that provides the markets with a reason for a little bit of an upside bounce in equities, but whether it can be trusted will be down to what's going to happen on the fiscal side, right? What type of retaliation do we get? If we get very positive comments coming out, so if we have like very important trade calls being announced between President Trump and Xi, or President Trump and the European Union, if we have some retaliatory calls taking place and comments that maybe the numbers will be reduced or tariffs will be removed, those types of things could be triggers to see additional upside or some recovery bounces in the likes of equities. If we don't get that though, as if the uncertainty remains high, it's going to be a very tricky environment to trade. Now, one thing that we can also look for, apart from just hoping for positive news coming out on the tariff side, is when it comes to equity specifically, look at things like the VIX. The 35 number is very important. The reason why this number is being watched so closely by markets right now is going back all the way to even pre-COVID, but let's just take post-COVID. 90% of the times when the VIX have moved into that 35 level, and this is looking at VIX futures, almost 90% of the time when we've moved into that 35 level, the markets have seen that as a buying opportunity. We actually had that or saw that in a note last week coming out from Goldman Sachs, where according to DataTrek, that's the number they're looking at to buy equities. When VIX gets to 35, that for them is going to be a buying opportunity. And if you take a look at some of these prior examples, you can see why, right? Every time that we test that 35 boundary, that was a short-term bounce opportunity for the S&P, short-term bounce. So all of these lows moving into that 35 level, you can see that normally we get that short-term buying opportunity. Whether that is a medium-term buy or whether it's just a short-term recovery move, it's yet to be seen, obviously. But 35 is going to be a key number. If we get to that level, that could spark some short-term upside in equities, as there will likely be players that steps in and tries to buy the dip when the VIX gets to that 35 level. The other asset that I just quickly wanted to touch on, and we got a couple of questions on this, as we usually do when equities have these types of moves, is what on earth happened to gold? Why did gold sell off, right? Because gold is normally seen as a safe haven asset. So why, if things get so hairy, so bad, why would gold be selling off? Now, it's important here to understand that gold, just like any other asset, obviously is bound to certain volatility dynamics, right? When volatility really ramps up, gold is one of those things, just like equities, that will normally be dumped in portfolios when the brown stuff hits the fan, right? When things get really, really gnarly, if volatility ramps up, you will have some systematic funds that needs to trim down those positions just purely because of how volatility ramps up in those assets. When it comes to gold, if you take a look at these numbers, they will make a little bit more sense for why we saw the moves that we did, and why you always have to keep that in mind when you trade gold in the midst of really bad equity days. So this is gonna get a little bit technical, but it's gonna be worth me quickly running through this. If you take a look at this left-hand side chart, right, this shows us the correlation that gold has to something like the S&P in average S&P return. So if you look at the average returns for S&P over the last 30 years, gold normally has a very close to 0% correlation, or very close to zero correlation to the S&P. That's exactly why it's such a key diversifier in any portfolio, because it has a very low correlation to equities. That's exactly what you want as a long-term position in something like gold. However, when you look at the right-hand side chart, this is isolating the worst of the worst of the worst days for the S&P. That is when the S&P will be down 3 to 12%, even in a session, right? In those days, like that 0 to 1 percentile days, take a look at what suddenly happens to gold. On those days, gold actually has a decent positive correlation with equities, meaning that when the brown stuff really hits the fan, when you start seeing portfolio allocators dumping positions, dumping assets across the board, when you see those huge margin calls taking place, massive amounts of allocation reductions taking place, in those environments, gold is actually positively correlated to equities. In other words, when equity sells off rapidly, like 2, 3, 4% in a day, don't be surprised to see gold follow suit and sell off alongside it, because that's what we normally tend to see based on those volatility dynamics. So that's just something that I wanted to add on, because we had a couple of questions coming in on gold, and rightly so. It doesn't really make a lot of sense, right? If you look at gold, everybody looks at it as a haven asset. It's actually just a haven when in normal environments, right? When the real brown stuff hits the fan, it's not really something that that you can hide in. That is where the dollar shines, right? That's why even after the initial sell-off last week, that's why the dollar eventually ripped, because there's only really one hedge when the brown stuff hits the fan, and that's the dollar, because there you can see the dollar now moves into close to a zero correlation with the S&P on those very, very bad days. So just keep that in mind for gold. But the bottom line is, guys, coming into this week, there's a lot of volatility in the mix. There's a few key things we'll be watching for. Like I said, do we get some positive comments coming out from the Fed? Do we get some positive comments coming out on the tariff side? That's going to be important to see a little bit of that volatility and that fear ease up. That 35 level in the VIX is going to be critical for us to watch as well. Apart from that, we don't have a lot else to focus on, and we're going to be bound by the markets flow. So just be careful out there. As always, trade safe and stay nimble. And if you've got any questions, as always, don't hesitate to reach out and let me know.